Pay attention, because what I'm about to walk you through is not noise, not hype, and not emotion. It's math, and math doesn't care about narratives. Registered silver inside COMEX vaults is sitting near 88 million ounces. Just 5.5 months ago, that number was around 200 million. That's a drawdown of roughly 111 million ounces in a little over 5 months, an average depletion of about 20 million ounces per month. 20 million every single month. At that pace, inventories don't stabilize. They disappear. Now layer this on top. The March contract roll is crawling. It needs roughly 30 million ounces per day rolling forward to keep pressure manageable. Yesterday, around 15 million. Half the required pace. If that pace doesn't accelerate, the math starts getting uncomfortable fast. This is where most people stop thinking. They assume there's always more metal somewhere. They point to the eligible category and say, relax, it can be transferred into registered. But here's the part they miss. Registered holdings represent net flows, inflows minus outflows. For months now, as the price spread between Western markets and Shanghai widened, silver has been leaving New York vaults. When Shanghai was paying significant premiums, metal flowed east. That tells you something critical. When price incentives appear, physical metal moves. And lately, it's been moving out. Even now, with roughly a $9 spread between New York and Shanghai, there is still more than enough premium to cover shipping and insurance costs. Physical demand isn't theoretical. It's directional, and it's measurable. Meanwhile, open interest on the March contract still represents hundreds of millions of ounces equivalent, against just 88 million registered. And settlement is approaching. If longs refuse to roll, price must rise to force that decision. That's not a conspiracy theory. That's how futures mechanics work. Now zoom out. Since September 2025, we've seen consistent depletion of registered silver. Not one chaotic spike, not one random week. A steady bleed. And steady bleeds are more dangerous than panics. Because panics get headlines. Steady structural drains do not. Let's talk about liquidity. The Federal Reserve just injected $18.5 billion into the U.S. banking system through overnight repo operations. One of the largest injections since the pandemic era. Liquidity injections of that size do not show up during calm, perfectly functioning conditions. They appear when pressure builds beneath the surface. Markets don't crack loudly at first. They tighten quietly. Now at a layer almost no one in mainstream finance is discussing. Military demand. Silver is not just an investment metal. It is critical for electronics, missile guidance systems, marine energy storage, advanced torpedoes, circuit boards, and high-conductivity military applications. Modern warfare is electrically intensive. Electrification increases silver intensity. The U.S. defense silver stockpile was effectively depleted decades ago. Strategic reserves that once existed are gone. That's not speculation. That's documented history. When geopolitical tensions rise, whether involving Iran or broader regional escalation, markets reprice energy, logistics, and safe havens. But they rarely price in the industrial consumption embedded inside modern defense systems. Wars do not just consume fuel. They consume materials. And silver sits quietly inside those systems. Now look at the structure of this rally. From roughly 33 to over 77, silver more than doubled. Normally, you'd expect speculative futures traders, managed money, to pile in aggressively during a move like that. But CFTC positioning data showed the opposite. Net long positions from managed money collapsed nearly 90% from mid-2025 levels. By early 2026, net longs were near multi-year lows. Speculators were not fueling this rally. They were being shaken out while price rose. That means something different was driving the move. Physical demand. When price rises while speculative positioning collapses, it suggests real-world buying pressure underneath the paper market. That's a very different structure from a blow-off top. Now, consider ratios. The gold-silver ratio sits near 64-1. Mining production ratio, roughly 1-8. Vault ratios between different exchanges show further imbalance. When relative valuations stretch this far from underlying production realities, one side eventually snaps. Reversions in commodity markets are rarely gentle. Then there's allocation. Historically, from 1921 to 1981, gold and mining equities represented around 24% of global asset allocations. Today, closer to 4%. To simply revert to historical norms, precious metals would need to outperform broader global assets dramatically. That doesn't happen overnight. But structural underownership creates room. And when surveys declare gold crowded, history has shown those declarations often occur before the next leg higher. Now, let's be balanced. The bearish case exists. Geopolitical escalation could cool. The Fed injection could prove routine. The March roll could accelerate in the final days. Eligible silver could move into registered. Military demand could be offset by recycling or substitution. Underweight allocations could persist for years. Those are real possibilities. But here's what cannot be ignored. 5 straight months of approximately 20 million ounces draining from registered inventories. 88 million remaining. Open interest multiples above that amount. A sluggish contract roll pace. Ongoing eastward physical pull driven by price premiums. Major liquidity injections. Strategic reserves depleted historically. Speculative positioning historically light. That combination is not normal equilibrium. Is tension. Markets can stay stretched longer than people expect. But when physical availability collides with paper leverage, price does not adjust gradually. It resets. And lower prices historically do not bring new silver supply online quickly. Mining is capital-intensive, slow, and constrained. When shortages emerge, they accelerate. The key point is this. Physical depletion mathematics do not negotiate. If inventories continue declining at current rates while demand persists and futures positioning remains structurally fragile, something must change. Either supply appears quickly, or price rises sharply enough to ration demand. Those are the only two mathematical outcomes. No hype, no drama, just arithmetic. Most people will ignore this until volatility forces them to notice. That's how markets work. Comfort persists until it breaks. The goal isn't panic. It's preparation. Understand the structure before the headline. Watch inventory flows, roll pace, spreads, liquidity injections, and positioning, not just price candles. Because when structural imbalances unwind, they don't send polite invitations. They move. Invest with logic, not emotion. Study the data, not the narrative. And never confuse temporary calm with structural stability. That's the difference between reacting and being ready.